Today, I'm going to show you how to use the BRRRR strategy on commercial property. And as always, I will leave a comment below with a table of contents if you'd like to skip around. There are many different commercial real estate investing strategies, and they run the gambit from simply lending money to other investors to running entire redevelopments. And whether you're looking to grow your commercial portfolio by flying solo or with a group of investors, the BRRRR method is a wonderful way to invest in real estate. In fact, it's the strategy that I've used on the majority of my commercial real estate investments. So let's dive into the BRRRR strategy using one of those buildings, 4015 Travis Drive, as an example. First, what is the BRRRR method? BRRRR stands for buy, rehab, rent, refinance, and repeat. It's been made very popular thanks to the hosts at BiggerPockets, who have given many examples of how this strategy can be used in residential investing. The goal is to buy an undervalued property, rehab only the parts that will add or create value, rent the property out to tenants, refinance it based on the new value or income, and move on to the next project. So today, we're going to be covering how to use the BRRRR strategy on commercial properties. Buy. The first step of the BRRRR method is to buy an undervalued property. Now, there are many reasons as to why a property could be undervalued. Maybe the owner doesn't know what it's worth, maybe the property needs to be rezoned or repositioned, or maybe the property just has a significant value add component. We bought 4015 Travis Drive in June of 2019. I had my eyes on that project since it came across my desk the previous November. The seller and I traded offers back and forth for several months before finally coming to an agreement. I utilized the fifth step of my 5 steps to buying your commercial property. Make an offer a week. And don't be afraid to make the offer that works for you. The owner was asking $1.3 million for the 12,070 square foot office building, and it had been sitting on the market for a bit. I offered $850,000 just to get the door open. Now, most investors wouldn't be willing to make an offer that low, but if you never make the offer, you will never get the deal. We ended up settling at $980,000 on the building, $320,000 under asking, and only $81.19 per square foot. With replacement costs sitting at around $130 a square foot, plus the cost of the land, we certainly knew that we had bought right. Rehab. Before you close on the property, you need to have your budget together for rehab. Walk through the project with your contractor and get a game plan together for the aspects of the building that you intend to improve upon. Now, something important to keep in mind, do not over rehab the property. I see investors do that all the time. They get too attached to the project and want to renovate it to the standard that they would want to see out of an owner-occupied space. Yes, you need to fix anything serious, like the roof and the foundation, and you need to improve the space, but only renovate the aspects that you know will increase the value of the space in a tenant's eyes. You are not renovating this property to the comps. You're renovating it to produce a higher net operating income. On 4015 Travis Drive, we decided to increase the curb appeal first. We repainted the exterior, sealed and striped the parking lot, updated the exterior doors, and added new landscaping. These updates gave the building an immediate bump in status. On the interior, we painted the walls, upgraded the doors, replaced the countertops in the common area kitchen and bathrooms, and replaced the floor with a sturdy hardwood LVP. Our renovation budget was right around $230,000 for all 12,000 square feet, so right at $20 per square foot. Again, every single one of these aspects was intended to help a tenant see the immense value they were getting by renting with us, so that they would lease the space. Rent. It's very important that you have a quality leasing and management team. When you're undergoing these renovations on the property, they will be able to begin marketing the space and touring tenants so that they can start pre-leasing the property before you have delivered it. Of course, the faster you rent the property, the faster you can refinance it and move on to the next project. The beauty of the BRRRR strategy is the rental rate you need to achieve to make the deal successful. Since you've bought well below market, you should be able to achieve market rents for what the building was prior to acquisition. Now you might be asking, Why would you do that? Well, because the lease up of the property will be very aggressive. Think about it. If tenants are looking at your beautifully renovated property and comparing it to older, rundown projects in the area that are at the same price point, they're likely going to choose your building. And that's exactly what we did at 4015 Travis Drive. Market rents for office space in that area were in the low $20 per square foot. When we bought the project to market for rent, we priced it in the low 20s per square foot, which pushed tenants to the project. They couldn't believe how nice the space was after touring other similarly priced office buildings. Now, yes, the NOI does have a direct impact on your property's value, and therefore the amount of cash you'll be able to pull out on a refinance. But the BRRRR method isn't designed to bring you the absolute maximum value on the property. You want to use this BRRRR strategy to quickly rent out a property, refinance it, and move on to the next project so that you can continue building your portfolio. Refinance. The refinance is where commercial property truly stands apart from residential real estate when it comes to the BRRRR method. While residential properties are valued based on comps, commercial real estate is valued based on net operating income through cap rates. The higher the NOI and the better quality of the tenants, the lower a cap rate your bank will place on the asset, which will in turn give you a higher value on the property. We aim to refinance these commercial properties the second they are stabilized, which is typically around 85 to 90% occupancy. Since we're not quite finalized on our Travis Drive project, I've only owned it for about 10 months at the time of this video, I will give you our projected refinance terms. So with an average rental rate of $23.50 per square foot and operating expenses of $7.50 per square foot, we expect to bring in a net operating income of $173,808 per year at 90% occupancy. At a 7.5 cap rate, which we feel is a bit conservative, and I always recommend that all your numbers lean heavily on the conservative side, you never know what could happen with the property. 4015 Travis Drive will be valued at $2.3 million. We will then refinance at that value with 20% equity remaining in the deal. So after paying off our loan, we will walk away from the refinance with north of $900,000, 2 times the equity necessary to purchase the building, and we will still own the project, which cash flows. That's right. We won't just pull out 100% of our capital. We're going to pull out 200% of our capital and still own the property. And the timeline projected to be 36 months with our realistic estimates in the 18 to 24 month range. The beauty of the commercial BRRRR is your ability to pull all of your money back out of a project to move on to the next one. And that brings us to our last step, repeat. The final step of the commercial BRRRR strategy is repeat. Now that you've successfully completed this project, it's time to go replicate it. Using the BRRRR method, you can see how quickly you can grow your portfolio of commercial real estate investments. Now, a couple things to keep in mind when using the BRRRR strategy. Seasoning the deal. Depending on your lender and their requirements, you may want to season the deal. Seasoning a deal means giving it time to settle in after stabilizing it, so there's enough data to prove it actually stabilized. Now, I've found letting the lender know our strategy ahead of time can help cut down on the time needed to season a deal, if any. However, if your lender does require you to season the deal, you shouldn't have any issues in the short term by waiting on the refinance. You've bought the property right, you rehabbed it right, and if you rent it to the right tenants, you should cash flow just fine in the meantime. Financing the deal. When we finance the project on the front end, we combine our construction loan with the acquisition loan. I also recommend discussing an interest-only period with your lender. And if you have a good enough relationship, for an interest-only period with interest carry in the loan. An interest-only period is a time where you're only responsible for paying the interest on your loan. This cuts your monthly carry costs significantly while you're renovating and repositioning a project. If you're able to get interest carry added in, then your lender is essentially lending you the money to make those monthly interest payments, so you won't have to come out of pocket for those costs. Having some sort of interest-only period, such as 12 to 18 months, is not uncommon for commercial projects that are being renovated and repositioned, so your lender should be familiar with the process. So there you have it for the commercial BRRRR. If you have any questions on how to go about the process, please leave a comment in the comments below, and I'll be sure to get back to you. If you like this video, please give it a thumbs up. And if you're interested in more commercial real estate investing strategies, leasing tips, and market updates, hit the subscribe button.